Retirement accounts are among the most powerful tools in the personal finance system, and they're underused by most people not because they are inaccessible, but because they are poorly understood. The tax advantages built into retirement accounts are not marginal. They are substantial, and when combined with decades of compound growth, they produce outcomes that are meaningfully better than investing the same dollars in a taxable account. This video covers the major retirement account types available in the United States, how each one works, the tax treatment of each, the contribution limits that apply, and the strategic logic for how to prioritize them given a specific financial situation. The foundational concept behind all tax-advantaged retirement accounts is that the government provides a tax benefit to encourage people to save for retirement, which reduces the long-term burden on public retirement programs. The tax benefit takes one of two forms depending on the account type. Either contributions are made with pre-tax dollars, reducing your taxable income today, while the money grows tax-deferred and is taxed as ordinary income when withdrawn in retirement. Or contributions are made with after-tax dollars, providing no immediate tax benefit, while the money grows tax-free and qualified withdrawals in retirement are entirely tax-free. The first structure describes traditional accounts. The second describes Roth accounts. Understanding the difference between these two structures and knowing when each is more advantageous is one of the most consequential decisions in personal financial planning. The 401k is the most widely used employer-sponsored retirement plan in the United States. It is offered by private sector employers and takes its name from the section of the Internal Revenue Code that governs it. A 403b is the equivalent plan offered by nonprofit organizations, schools, and government entities. The mechanics are identical for practical purposes. An employee elects to contribute a percentage of their paycheck to the plan. Those contributions are invested in a menu of funds offered by the plan, and the account grows over time. The contribution limit for 2024 is $23,000 per year for employees under 50, with an additional catch-up contribution of $7,500 allowed for employees 50 and older, bringing the total to $30,500. Traditional 401k contributions are made with pre-tax dollars. Your contribution is deducted from your taxable income in the year it is made, which means you pay less income tax today. The money grows tax-deferred, meaning no taxes are owed on gains, dividends, or interest within the account from year to year. When you withdraw the money in retirement, the withdrawals are taxed as ordinary income at whatever tax rate applies to you at that time. The logic of a traditional 401k is most favorable when you expect to be in a lower tax bracket in retirement than you are during your working years, because you defer taxation from a high-rate period to a lower-rate one. Roth 401k contributions, offered by many but not all employers, are made with after-tax dollars. You receive no tax deduction today. The money grows tax-free, and qualified withdrawals in retirement are completely tax-free, including all of the growth accumulated over decades. The logic of a Roth 401k is most favorable when you expect to be in the same or higher tax bracket in retirement than you are today, because paying taxes now at a lower rate is better than paying taxes later at a higher rate on a much larger balance that includes decades of growth. For most people early in their careers who are currently in lower tax brackets and whose income is expected to grow substantially over time, the Roth structure is generally more advantageous. For people in peak earning years who are currently in high tax brackets and expect lower income in retirement, the traditional structure may be more beneficial. For people who are uncertain about future tax rates, which is a rational uncertainty given that tax law changes frequently, splitting contributions between traditional and Roth provides diversification across tax treatments, which is valuable in its own right. The employer match is the most important feature of any 401k plan and the first priority in any retirement savings strategy. Many employers match a portion of employee contributions, commonly 50% of contributions up to 6% of salary, or 100% of contributions up to 3% of salary. An employer match is an immediate 100% return on the matched dollars. If your employer matches 50 cents for every dollar you contribute up to 6% of your salary, contributing at least 6% means you are receiving a 3% salary supplement in the form of retirement contributions. There is no investment in the financial system that offers a guaranteed immediate return comparable to a full employer match. Contributing at least enough to capture the full match before directing retirement savings anywhere else is the correct first step regardless of other financial circumstances. The individual retirement account, commonly called an IRA, is a retirement account opened by an individual independently of any employer. The two primary types are the traditional IRA and the Roth IRA, which follow the same pre-tax and after-tax structures as the traditional and Roth 401k respectively. The contribution limit for IRAs in 2024 is $7,000 per year for individuals under 50, with an additional $1,000 catch-up contribution for those 50 and older. The Roth IRA has income limits that restrict contributions for higher earners. For 2024, the ability to contribute to a Roth IRA phases out for single filers with modified adjusted gross income between $146,000 and $161,000, and for married filers between $230,000 and $240,000. Above the upper limit, direct Roth IRA contributions are not permitted. A workaround called the backdoor Roth IRA, which involves making a non-deductible traditional IRA contribution and then converting it to a Roth IRA, is available to higher earners who wish to access the Roth structure. The mechanics and tax implications of this strategy are worth discussing with a tax professional if applicable. Traditional IRA contributions may or may not be tax deductible, depending on whether you have access to a workplace retirement plan and your income level. If you're covered by an employer plan like a 401k, the deductibility of traditional IRA contributions phases out above certain income thresholds. For 2024, the deduction phases out for single filers covered by a workplace plan with modified AGI between $77,000 and $87,000. If you are not covered by a workplace plan, traditional IRA contributions are fully deductible regardless of income. Non-deductible traditional IRA contributions, made when deductibility is not available, provide tax-deferred growth but no immediate deduction, and the tax treatment of withdrawals is more complex, requiring tracking of the after-tax basis in the account. The health savings account, introduced in the insurance video, functions as a supplemental retirement savings vehicle for people enrolled in high-deductible health plans. The triple tax advantage of the HSA, deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses makes it uniquely powerful. After age 65, HSA funds can be withdrawn for any purpose and are taxed as ordinary income, similar to a traditional IRA, making the HSA function as an additional traditional IRA equivalent for non-medical expenses in retirement. For medical expenses in retirement, which are substantial for most people, the HSA maintains its tax-free withdrawal advantage indefinitely. Maximizing HSA contributions before or alongside IRA contributions is a strategy worth considering for people with access to a high-deductible health plan. Required minimum distributions, commonly called RMDs, are mandatory withdrawals that the IRS requires from traditional IRAs and traditional 401k accounts beginning at age 73 under current law. The required amount each year is calculated based on the account balance and IRS life expectancy tables. RMDs exist because the government deferred taxation on these accounts and eventually requires that the deferred tax be collected. Roth IRAs are not subject to RMDs during the original owner's lifetime, which makes them particularly valuable for estate planning purposes and for maintaining flexibility in retirement income. Failure to take required minimum distributions results in a substantial penalty, currently 25% of the amount that should have been withdrawn, which is why tracking RMD obligations as retirement approaches is important. Early withdrawal from retirement accounts before age 59.5 is generally subject to a 10% penalty in addition to applicable income taxes, which is a substantial cost that effectively makes retirement accounts illiquid for most purposes before that age. There are exceptions for specific circumstances, including certain medical expenses, first-time home purchase from a Roth IRA, substantially equal periodic payments under IRS Rule 72T, and others, but these exceptions have specific requirements and limitations. The penalty structure reinforces the intended purpose of these accounts as long-term retirement vehicles and is worth understanding clearly so that retirement savings are not inadvertently treated as an accessible emergency fund. The standard prioritization framework for retirement savings, given an employer-sponsored plan and access to an IRA, is to first contribute enough to the 401k to capture the full employer match, then maximize the HSA if eligible, then maximize the Roth IRA if eligible and income permits, then return to the 401k to maximize contributions up to the annual limit. This sequence captures the most immediately valuable benefit first. The employer match applies the most tax-efficient vehicle second. The HSA takes advantage of the Roth IRA's superior flexibility and tax-free growth third, and then directs remaining retirement savings into the 401k. Variations on this sequence are appropriate, depending on individual circumstances, including whether traditional or Roth elections are preferred, whether the employer's 401k fund options are high quality, and whether specific financial goals are competing with retirement savings for available dollars. The most important message of this video is that the tax advantages of retirement accounts are not a technicality. They are a fundamental multiplier on investment returns that compounds over decades. Every dollar saved in taxes through a retirement account contribution is an additional dollar that compounds in the portfolio rather than being paid to the government today. Over 30 or 40 years of working life, the difference between investing in tax-advantaged accounts and investing the same amounts in taxable accounts represents a significant and concrete difference in the ending balance available in retirement. Understanding these accounts clearly and using them fully, starting as early as possible in a working life, is one of the most directly impactful financial decisions available to anyone building long-term wealth.